Hello, everybody. We'll get started in just a few moments. Hello, and welcome to our Expat Tax Preparation webinar. Today, we're going to talk about the tax filing requirements for expats, as well as some of the most important issues you need to understand when preparing your tax return. We'll also talk about the benefits of working with a professional tax preparation company. By the end of this webinar, you should understand your basic obligations as an expat, as well as some of the more common pitfalls and misconceptions. If you stick around until the end, we even have a special bonus for you. Finally, we'll save a few minutes at the end of the presentation to answer your questions. You can ask your questions into the chat box. And if we run out of time to answer your specific question, or you prefer to reach out to us privately, please let us know. For those of you joining us, we'd love to hear from where you are from. And before we dive in, let's take a minute to talk about who I am and why my advice matters. My name is Randall Brody, and I'm a licensed enrolled agent with over 25 years of experience helping U.S. expats stay compliant with the IRS. All members of our firm are either CPAs or enrolled agents. We specialize in expat taxes, and we know all the regulations inside and out. Not only have we helped thousands of expats prepare and file their tax returns successfully, but we also know all the ins and outs for dealing with back taxes and delinquent returns and compliance issues. So let's get started. We'll start with a simple but common question. Do expats really have to file a tax return? After all, you're living and working in another country, so why should the U.S. care about your income? Unfortunately, the U.S. is not like other countries when it comes to foreign sourced income. The U.S. tax filing requirements apply to worldwide income, so living abroad won't excuse you from filing or paying taxes to the IRS. In fact, if you're a U.S. citizen or resident, you're still subject to all the same filing requirements, even if you aren't living or working in the country at any time during the year. You may even need to file additional documents when you live abroad that aren't required for most taxpayers in the U.S., such as a report of your foreign bank account holdings, known as the FBAR. Although the U.S. requires most expats to file a return, that doesn't mean you'll owe a large bill when you're done. In fact, the IRS offers several tools that expats can use to lower their tax liability or even eliminate it altogether, especially if you've already paid taxes overseas. The first of these tools is the foreign earned income exclusion. If you qualify for this exclusion, you can exclude a large portion of the money you earned outside of the US from your taxable income. For tax year 2019, the maximum foreign earned income exclusion is the lesser of the foreign income earned, or $105,900 per qualifying person. For tax year 2020, the maximum exclusion is $107,600 per person. If two individuals are married and both work abroad and meet either the bona fide residence test or the physical presence test, each one can choose the foreign earned income exclusion. Together, they can exclude as much as 215,200 for the 2020 tax year. This is a number that's adjusted every year for inflation. To qualify for the foreign earned income exclusion, you need to meet a few requirements. First, you must have your tax home in a foreign country. Your tax home is the place where you usually conduct business. It doesn't necessarily need to be your family's place of residence. However, keep in mind that the IRS will not consider you to have a tax home in a foreign country if you're maintaining an abode in the US, even if all your money comes from foreign sources. In addition to having a tax home in a foreign country, you must also pass either the physical presence test or the bona fide residence test. To pass the physical presence test, you must be physically present in a foreign country for at least 330 days in a period of 12 months. These 12 months must be consecutive, and the period can start or end during the tax year in question. The 12-month period you use to satisfy the requirements of this test must also contain at least 365 days. For this test, the IRS defines a day as a period of 24 hours that begins at midnight. If you travel in and out of the US during the year, keeping careful track of travel time and time spent inside a foreign country is essential. To pass the bona fide residence test, you must be able to show that you're a bona fide resident of a foreign country for the entire tax year. This may sound simple, but it's important to note that simply living inside another country during the tax year won't automatically make you a bona fide resident. To be a bona fide resident, you have to prove that you not only do you live in another country, but that you have established a residence you intend to keep for an extended period. The bona fide residence test becomes more complicated when certain tax treaties are involved or when you've made certain statements to foreign governments. So it's best to talk to an expert if you're hoping to use this test to claim the foreign earned income exclusion. The IRS will decide whether taxpayers pass this test on a case-by-case basis. If you satisfy the requirements for the foreign earned income exclusion, you can use it to exclude wages or self-employment income you earned for work you did outside of the US. Although you can include commissions and bonuses, you can't include self-employment taxes, which are Social Security and Medicare taxes based on the net income from self-employment. Nor can you exclude income earned as a government employee or passive income. Another tool available to help you reduce U.S. taxable income as an expat is the foreign housing exclusion and deduction. The foreign housing exclusion and deduction can be used to deduct any qualifying housing expenses you paid from self-employment income or to exclude any housing expenses paid from funds provided by your employer. Your housing amounts are calculated by your total housing expenses less a base housing amount. Qualifying housing expenses include things like rent, repairs, utilities, insurance, rental furniture, and parking costs. Certain lavish expenses, such as the cost of maid service, can't be included as qualified housing expenses. Keep in mind that there are specific limitations on this tax benefit, and the calculations can be complex. It's also important to note that you can't double dip when you're claiming the foreign housing exclusion and deduction. Housing expenses paid with income you've already excluded can't be deducted or excluded a second time. To claim the foreign earned income exclusion and the foreign housing exclusion and deduction, you must submit Form 2555 to the IRS. If you're a calendar year filer, this form generally will be due on April 15th with your annual tax return. However, if you're living in a foreign country on the normal April 15th tax deadline, You're automatically granted a 2-month extension on the deadline for this form. Normally that's June 15th. However, for all US taxpayers, the IRS has extended the tax filing and tax payment deadline this year, just for this year, to July 15th. So let's move on to the foreign tax credit, which is another excellent tax benefit available to expats. The foreign tax credit is designed to reduce the burden of double taxation, which would occur if you pay taxes on the same income to both the US and a foreign country. If you qualify for this, you can directly reduce your US taxable liability dollar for dollar by the amount of income tax you paid to a foreign country. The foreign tax credit is available to individuals, estates, and trusts that paid qualifying taxes to a foreign country or US possession. The credit isn't available to non-resident aliens in most cases. In general, only income taxes paid on foreign source income will count towards this credit. Foreign source income includes compensation for services performed in a foreign country, foreign interest income, and foreign corporation dividends. To be considered a qualifying tax for this credit, the foreign taxes you paid must be legal and actual, which means that you legally owed them and must have actually paid them. If you could have been exempted from the tax, it can't be used to claim this credit. Qualifying foreign taxes must also be imposed directly on you, and you must be able to show that you have already paid them or will have to pay them. Finally, these foreign taxes must be income taxes. If you ultimately receive a refund for taxes you used to claim the foreign tax credit, you'll need to amend your US tax return. Certain taxes are specifically excluded from this credit, including refundable taxes, taxes that could have been legally avoided, and taxes paid to governments not recognized by the US. Likewise, you can't claim any taxes paid to governments the US has designated as supporters of terrorism. You must actually you file the Form 1116 to claim the foreign tax credit. However, you may be able to claim the credit without this form if you meet certain requirements. Keep in mind that claiming the credit without filing the Form 1116 prevents you from being able to carry forward or carry back excess foreign taxes. You can't claim both the foreign earned income exclusion and the foreign tax credit on the same income. As a result, many expats have to choose between taking one or the other. Depending on your unique situation, one option may be better than the other. In some cases, it may also be possible to split income between the foreign earned income exclusion and the foreign tax credit. If no foreign taxes were paid, it's an easy choice. However, if you did pay foreign taxes, the situation is more complicated. An expat tax expert can help you decide which option is best for you based on your unique situation. Even after you have applied the exclusions and credits available exclusively to expats, you may still have taxable income. If this is the case, you may be able to use other credits and deductions to lower your bill even more. Expats have access to many of the same standard benefits available to taxpayers living in the US, such as deductions for mortgage interest and state income taxes paid. Foreign property taxes, unfortunately, are no longer deductible on Schedule A, but you want to be sure to take advantage of these benefits to minimize your US tax liability as much as possible. Income tax is not the only US tax you may need to consider as an expat. If you're self-employed and working in a foreign country, you are still subject to US Social Security and Medicare taxes. Unfortunately, many foreign countries collect their own Social Security taxes, leading to double taxation for many expats. None of the tax benefits we've discussed so far can be used to eliminate this obligation. However, relief may be available if you're earning income in a country that has a totalization agreement with the US. These agreements eliminate double Social Security taxation, allowing you to pay Social Security taxes to only one country. These agreements aren't available in every country, and where available, a certificate of coverage from the foreign country must be attached to your federal tax return. So it's important to do your homework. Just being an expat doesn't exempt you from income tax filing requirements or Social Security. It also doesn't exempt you from gift tax either. As for US residents, you can make unlimited tax-free gifts to a US citizen spouse. However, if your spouse isn't a US citizen, a special threshold may apply. For all other people, you will need to report gifts that exceed a certain threshold during the year. For 2020, the threshold is 15,000. Most taxpayers will be able to use their lifetime gift tax exemption to avoid paying taxes. Uh, However, you will still need to file a gift tax return. State taxes may apply to expats as well, and these taxes will be based on your worldwide assets. The IRS allows an exemption in estates with combined gross assets and prior taxable gifts over a specified amount. Above this amount, it may be subject to taxation. Taxes are levied on the estate, not the people who inherit. Many people mistakenly believe that moving out of the country eliminates all state tax obligations. Unfortunately, this isn't always the case. If you're still considered a resident of certain US states, you may owe taxes to that state even when you live outside the US for the entire tax year. To avoid issues with state taxes, it's important to learn about the laws in the state you moved from. Each state has different residency rules that apply to taxation, and failing to file a required tax return and or pay state taxes you owe can lead to penalties. Before we move on to other IRS requirements for expats, let's take a moment to talk about the importance of filing a return. Many expats who don't owe tax to the US will still need to file an income tax return. Failing to file a required return can lead to penalties. Because these penalties can be serious and you may lose out on valuable tax benefits, ignoring the obligation to file a return is never a good idea. So be sure to file on time every year, regardless of your expected tax bill. Filing tax returns isn't the only responsibility you have as an expat. You may need to file information disclosures to the IRS as well. One of the most common disclosures required is the FBAR, and the FBAR stands for Foreign Bank Account Report, which is also known by its form, FinCEN Form 114. This form is required by the IRS to aid the US government in determining if a US taxpayer is evading US income tax. Another common international disclosure is the Form 8621, which is generally required whenever you invest in a foreign mutual fund. The US classifies such investments as PFICs, or passive foreign investment companies, and as such are subject to very punitive and costly tax disclosure requirements, along with very high tax rates. An FBAR may not be required for every taxpayer who has assets overseas. However, if you're a US citizen or US resident with significant financial interests abroad, you probably need to file this form. Specifically, you must file the FBAR if you have a financial interest in or any signing authority over foreign accounts with an aggregate value of more than $10,000 at any time during the year. Foreign accounts include any account held at an institution outside the US. Keep in mind that you must file this form even if you have only signature authority over a foreign account. Likewise, even if the account produced no taxable income, its balance still counts for the purposes of FBAR filing requirements. Keep in mind that the filing threshold for the FBAR is based on the aggregate balance, not the individual balances of each account. Even if none of your accounts has a balance over $10,000 during the tax year, you'll still need to file this form if the total of all account balances were higher than the threshold at any point in time during the year. Because the FBAR is only a report, it's common for expat taxpayers to view it as no big deal. However, this is not an IRS requirement you can afford to ignore. If you don't file a required FBAR, you may face fines and penalties with the IRS. Failing to file an FBAR can even lead to criminal charges. It is also a deceptively easy form to complete in that it is an easy form to fill out, but easy to make costly reporting errors and omissions by not knowing what needs to be reported and how. You may think you can fly under the radar with this requirement, but the IRS will know if you don't file. Foreign financial institutions are required to collect and report certain information about accounts owned by U.S. taxpayers, giving the IRS everything it needs to discover your unfiled FBARs. Like your tax returns, FBARs must typically be filed by April 15. However, the last couple years, including this year, an automatic extension until October 15th has been granted for those who missed the April 15th due date. You must file this form every year that your accounts meet the filing threshold. Another form some U.S. expats must file is the Form 5471, which applies to U.S. persons who are officers, directors, or shareholders in certain foreign corporations. This form reports the activity of the foreign corporation to the IRS. Like most international disclosures, it carries the potential for hefty fines if not filed on time or accurately. If a certain threshold is met, you need to file the Form 8938, the Statement of Specified Foreign Interests as well. For a single U.S. resident, that threshold is $50,000 on the last day of the tax year or $75,000 at any time during the year. For a couple that is married filing jointly, it's $100,000 at the year end or $150,000 at any time. For single taxpayers residing abroad, the threshold jumps to $200,000 for year end and $300,000 at any time. While taxpayers filing jointly and residing abroad must meet the threshold if total foreign specified assets exceed $400,000 on the last day of the tax year or $600,000 at any time during the year. Keeping up with all the IRS and filing and tax payment obligations is essential for all expats. Unfortunately, many expats simply aren't aware of the IRS filing requirements, and as a result, may have multiple unfiled returns and/or back taxes, or even incomplete or missing disclosures. If this is the case for you, you need to move quickly to minimize the consequences. The longer you leave the situation unresolved, the more likely you will be to face harsh penalties. The first step usually involves filing all the returns you missed and coming into full compliance. You'll also need to take steps to resolve any tax debts you owe as applicable. Fortunately, the IRS offers several options for taxpayers who want to resolve outstanding debts. At Tax Samaritan, we specialize in helping expats with all of their U.S. tax needs, from filing returns to resolving unpaid tax debts. If you have unfiled returns or international disclosures, we can help you deal with these issues quickly as well. Please contact us to learn more about our services. If you're ready to move forward, respond to the email that I'll be sending very soon. If you're not quite ready to take that initial step, we can offer a private, no obligation chat with you. Just call or email us and we'll be able to start helping you. If you would like to receive a complimentary copy of our Expat Tax ebook, please visit the link that you see on the page. Finally, we have a few minutes left so we can answer some of your specific questions. Please feel free to post them in the chat window, and I'll be happy to be of help. We'll wait a few moments to see if you have any questions. Good morning, Philip. All right. First question is, if claiming bona fide residence, do you need to attach proof with the return or provide it only if requested to do so by the IRS? So no documentary proof or evidence needs to be attached to the return. There's specific questions that are answered as part of the claim on the Form 2555, but additional details do not need to be provided unless it's requested by the IRS. All right. So a question about foreign tax credit with partnership income. If you have a foreign entity, that's a very, very, very complex question. Generally, you'll have a Form 5471 filing requirement depending on your ownership level. But that's a very, very complex question, not something that I can easily answer in a short conversation. I have a FBAR question. My total of savings accounts were under $10,000. How do I respond to the IRS? I'm not sure what the question is, what the IRS is asking of you. If you'd like, you could add that into the chat box, or we can correspond privately if you prefer. Is the child tax credit available to expats? I know there were audits because it was claimed by those not eligible. Yes, you can claim the child tax credit. However, the additional child tax credit is only available if you are not claiming the foreign earned income exclusion. So yes, I'd imagine there were audits for individuals that claimed the additional child tax credit while claiming the foreign earned income exclusion at the same time. Certainly that would be, a very easy audit for the IRS to perform. All right. Let's see if there's any additional questions. Please feel free to add them into the chat box. Another question. I work in a foreign country 6 months a year, but I'm paid income via US company and pay US taxes. Do I qualify for expat taxes? Uh, you would still need to qualify under the foreign earned income exclusion. So if you're physically performing the work in a foreign country, it is considered foreign earned income. So it does meet that classification, but you still would need to qualify under the physical presence test or the bona fide residence test. If you were spending 6 months in a foreign country and 6 months in the US, and that's 6 months on, 6 months back in the US on a rotating schedule, then you would not qualify for the exclusion. Are virtual currencies reported in the FBAR? How about Payoneer, PayPal, and the likes? If it's held in a wallet that is held outside of the US, then current guidance is yes, definitely claim that on the FBAR. In all situations, whenever there's uncertainty or there's a gray line on whether or not to report something on the FBAR, the safest and most conservative approach is always just to report it. There's no harm or penalty or tax in over reporting. It's better to be safe and over report versus be at risk and under reporting. The next question, if you file a joint tax return and one spouse claims the income exclusion, the other claims the tax credit, are they eligible to claim the child tax credit? No, they wouldn't. They would not be eligible to claim the additional child tax credit. Child tax credit, yes, it's possible to be eligible, but not the refundable portion, which is known as the additional child tax credit. All right. If you have other questions, feel free to place that into the chat box and I'll be happy to answer. Are employer contributions to foreign pension accounts taxable income? Great question. Yes, they are. Generally, foreign pension accounts are not qualified retirement accounts for the U.S. tax code, so there is no uh, uh, deferment of employer contributions. They're added in as earned income, not eligible for the exclusion, and hence are included in your taxable income. You're welcome, Eva. All right. So if we have no other questions, I'd like to thank you for your time. And if you have other questions, feel free to reach out to us directly at help@taxsamaritan.com. I hope that you have a wonderful rest of the day, and wherever you are located, I hope that you are safe and healthy and continue to be so. Thank you.